Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. Bit of a different setting today. I'm in the land of koalas and kangaroos and a whole bunch of poisonous stuff, being Australia. So bit of a different setting today, filming this in a basically hotel room while I'm over here for a couple of weeks. So today we're going to dive into a topic that's pretty hotly debated in the investing community, and that is how many stocks should you actually own in your portfolio. Should you own 5, 10, 50, 100, 1? What are the factors that should influence your decision in terms of how many companies you own in a portfolio, and how do I personally sort of approach that? So I hope you do enjoy the video. If you do, hit like, hit subscribe, and that way you can see future videos as well. Let's get into it. So personally, I think the biggest thing that's going to impact how many stocks you own in your portfolio is your overall strategy. So personally, I'm a value investor. I'm looking to assess individual companies, figure out what sort of return I think I can make at the current price that those companies are trading at, and pick the ones that offer the best return at that time. So that's my personal approach. I think a very common approach, and the one that I think most people should probably be taking, is more of a broad diversification index fund type approach, investing in ETFs, the New Zealand Top 50, the S&P 500 type investment options. So let's talk about ETFs first. I think if you're going to be an ETF investor, you're obviously by default going to be very diversified. You're going to own a lot of stocks. If you own just the NZ Top 50, for example, that's going to give you diversification across 50 companies. So although in practice you're just buying one stock, which I'll put on the screen here, you actually own 50 companies, and you're diversified across all of those businesses. So there's pros and cons to being diversified. The big one is that it's going to, typically speaking, limit any drastic losses. So the only time that you're really going to have significant drops in your portfolio, if you have significant diversification, is with a general market meltdown or a general market sort of crash. So that's great. You're not going to wake up one day and your portfolio is down 20 or 30% unless we have something insane happen in the general market. You're not at the risk of individual companies, kicking your portfolio on the butt and having big drops. But at the same time, you are essentially locking in average. So if you have any intention of outperforming the indices, or when the general market crashes, still doing relatively well, you're throwing that out the window with diversification and going into ETFs. So that's the advantage of picking individual stocks. There's probably going to be a little bit more volatility if you own a small number of individual companies, but over the long term, if you're picking those companies well, doing good fundamental analysis and sticking with them over the long term, being patient, buying things at the right price, you should have a good chance of doing very well over the long term. So one of the core tenets that I picked up from Ben Graham's The Intelligent Investor is this concept of margin of safety, and buying businesses and buying stocks for less than they are intrinsically worth based on the productive capacity of a business. So based on how much cash that business produces relative to the price that you have to pay for that business. So if a business is worth $100 a share and you can buy it for $50 a share, that gives you a big margin of safety in terms of whether the business has to execute on its plan for you to have a great investment return. And if things work out well, you can produce some very, very high returns if you're able to pick up businesses for 50 cents on the dollar. So I think the main thing that dictates the number of stocks in a portfolio in that sort of value investing approach is really how many opportunities are out there. And that's going to be pretty much the core driver of how many stocks you actually have in an investment portfolio. So I think that market conditions actually have a very big impact on the number of stocks that a person should own. So what I mean by that is we've got very, very high market prices, historically speaking, right now. Sure, interest rates are low, and that means that the stock market should, in theory, be at a higher valuation than normal. But we have very, very high prices. We have a high Schiller PE. We have a high Wilshire 5000 to GDP ratio over in the US. All these historic metrics are tapped out. They're very, very high. And what that means from a practical standpoint is when we search for businesses that are undervalued and we're searching for businesses that give us a margin of safety. So, if it's worth $100 and we can buy it for $50, we've got a $50 sort of gap margin of safety. Those businesses are limited. So I think what's going to happen naturally for investors that have the same strategy as me, value oriented, trying to buy 50-cent dollars, I think naturally we're going to become more and more concentrated as these bull markets progress. So we're going to own less and less stocks as stocks that we purchase in cheaper markets appreciate closer to intrinsic value. We're going to start reducing the size of those positions. We're going to probably stack our cash pile a little bit higher and just become more and more concentrated over the long-term kind of bull market situation. So it's not ideal. I don't think I want to have 100% of my net worth in one stock or anything like that. But right now I do own less than 5 stocks. I am very concentrated in a small number of names. But at the same time, I have a big buffer. So I have a buffer of cash that I've got sitting on the sidelines and a pile that I've been building up. Not literally a pile in my bedroom or anything like that, but I've been saving as much money as I possibly can so that when prices do get cheaper, I've got these companies on my watch list, I've got cash ready to go, and I can invest aggressively when prices are right. So I think it's sort of the natural thing to do that you become more concentrated as prices rise. I think if it were 2008 today and I was, building a portfolio now, I think there would be a lot more opportunity in terms of buying those 50-cent dollars. I would probably own, 10 stocks, for example, but that's probably as high as I'd push it. And there's a couple of reasons for that. So if you own more than 10 stocks and you are genuinely heavily involved in researching these companies and keeping up to date and understanding the ins and outs of them, I struggle to believe that someone can understand more than 10 companies and keep up to date with more than 10 companies all the time, especially if they have a day job. So if you've got a day job and you own 50 stocks, I highly doubt that you're going to be able to, read the annual reports, read the quarterly reports, listen to the conference calls, keep up to date with news, do all that stuff for 50 stocks. I don't think anyone can do that. And even if you can, I don't think you're going to like stock number 49 as much as you like stock number 3. And I don't think the returns you're going to get from those stocks are going to be anywhere, close to each other. So if you know what you're doing and you're really diving deep into those businesses, even if market conditions are horrendous and prices, are low, which horrendous means great for value investors, even in those conditions, I don't see myself owning more than 10 stocks personally. If you're an ETF investor or an index investor, sure, you can be more diversified. That's fine. That's your strategy. You don't understand these businesses inside out and you don't particularly care about what's happening in the market. That is what ETF investors should be very good at. But if you're a value investor, picking individual companies that you think are going to generate very high returns, I think that you need to stay on top of them research-wise, and for that reason, I don't want to get north of 10. The other thing is that if I do go in and do all this research on businesses, I want to have those investments make as bigger positive impact on my net worth as possible. So if it's 1% of the portfolio and it triples, that doesn't make much of a difference in my life. But if it's 20% of the portfolio or 30% of the portfolio, Mohnish, Pabrai and old school Warren Buffett style, then if it doubles or triples, it makes a huge impact on your portfolio and a huge impact on your net worth. So there's definitely pros to concentration as opposed to diversification. There's cons to it. I think you've got to be confident and you've got to really know what you're doing in terms of being able to value a business and understand a business's long-term performance. But that's my 2 cents on how many stocks you should own. Personally, I'm quite concentrated right now. Long term, I might sit in an average range of somewhere in the 5 to 10 sort of business, 5 to 10 stock sort of range. So that's me. I'm really keen to hear your thoughts on how many stocks you think you should own in a portfolio as well. I'm definitely pro concentration and I've made a couple of videos along these lines already. So apologies if you're hearing similar themes again. But I hope you enjoyed it. I think it's an important lesson that if you are really diving in and doing the research, that you want to get the biggest impact possible positive wise on your portfolio that you can, but at the same time, you know, there's always risk that comes with investment, so you want to have some element of diversification as well. So hope you enjoyed the video. If you did, hit subscribe, hit like, and have a great day. Cheers.
But mate, all I had was me jocks on. I was chasing him up the straight, and I'm just like, mate,